what would be like your tips into finding the real businesses from the value traps would be the bottom of the question, I guess.
Yeah, Javier, that's a great question. And I have practiced different styles of investing. They're all within the value investing tent. It's a very large tent, and within that tent, you can do many, many different things. For example, recently, Buffett was buying the stock of Activision Blizzard, which is in the midst of being acquired by Microsoft, and the market believes that that deal will not go through. And so the spread between the price that Microsoft is willing to pay and the price at which Activision Blizzard, I haven't looked at it recently, but the price at which it was trading or is trading is a very wide spread. But Buffett mentioned at the annual meeting that the reason he bought the stock is purely merger arbitrage. He believes that statistically it is high probability that that deal will close. And if it does close, you capture that gap. We have a similar gap with Twitter, right, where Elon Musk has, asked or, has a deal to buy the stock at a particular price, and the market doesn't believe that that's going to happen. A lot of people believe that he can't get out of it, which we will find out in a few weeks. So I think both of those cases would be part of value investing. You had some reason to believe that these were high probability events, that Activision Blizzard is likely to be bought by Microsoft, and the Twitter deal might get done. Maybe there is a small adjustment, but mainly gets done around the price that was agreed. And you made those bets, then that's a very valid way to go about it. What I think is the best way to invest is to focus on the great business. There are many things you could do: merger arbitrage, buy a business that's trading well below liquidation value, maybe below cash. And there are a number of different ways with which you can protect downside. But generally speaking, the way you will make the most money is by the partial ownership of a business which has tremendous economics and a tremendous runway. If you are in the happy position of the ownership of a tremendous business with a tremendous runway, for the most part, you only need to be right once or twice in a lifetime, and it would cover a lot of sins. Recently, there was a lot of coverage about a Indian investor, Rakesh Jhunjhunwala, who just passed away. I didn't know him, but I have friends who are close friends of his, so he's kind of a friend of a friend. Rakesh was 62 years old. He was in poor health. He passed away with a net worth of over $4 billion. All of it was from the market, and he never managed outside money. I mean, if he had decided to open an investment advisory business, billions of dollars would have come to him. But he wasn't interested in that. So he just managed his own money. And when he first started, he's a chartered accountant, a CPA. When he first started, maybe in his early 20s, about 40 years ago, he had no money. He had absolutely like zero. He went to this lady and requested her to give him a loan of about $25,000 so he could buy some stocks. So the lady told him, if I give you this money, what is the guarantee? What guarantee can you give me? What collateral will I get? So he said, look, the only collateral I can give you is my signature. I have nothing else. I have no assets. So you should only give me the money if you trust me. So she didn't fully trust him because he's an unknown guy. But she tells him, okay, listen, here's what you do. You take the 25,000. I'm going to first give you 12,500. You go buy stocks with the 12,500, and then you give me those shares. I will hold custody to those shares. They are your shares. The upside belongs to you, but that's my security. So he said, done. He also agreed to pay her 18% interest for the money, which is, I would say this was a different time, probably early 80s, normally you would, in India, you would borrow at 12, 13%. Rakesh paid 18%. And then, he started to invest, and he was a kind of, I would say he was a split brain. He did a lot of rapid fire trading, but he also had two really long-term holds. So there's a company in India called Titan Industries, which I think he invested in maybe 20 or 25 years ago. And when he made that investment in Titan Industries, it was like 3 or 4% of his portfolio. He never sold a share till he died. He died with those shares. And out of the 4 billion, around 2 billion was Titan. And Titan compounded at something around 30% a year, 30 or 35% for more than 2 decades. And actually, if you study Titan, I don't want to go off track because your members won't have much interest in studying Titan. But if you study Titan, basically, it's a jeweler. And in India, the only jewelers you would do business with was ones that your family had done business with for a long time. So you could have some trust. Because, when you're buying gold, you don't know whether it's fake or real or whatever else. Titan was, it was promoted by one of the large Indian conglomerates who was very trusted. And so they had natural trust. Indian jewelry was very fragmented. And now Titan is gradually consolidating that. It's, in my opinion, Titan still has maybe a 50-year runway ahead of it. It's got a huge runway ahead because it's so, but to give Rakesh credit, company went through lots of ups and downs, but he understood the business. And when it became 10, 20, 30, 40, 50% of his portfolio, he was least bothered about it, just kept it. And then there was another company, Lupin, which is the pharmaceutical industry. And I think Lupin became 25, 30% of his portfolio. So he was doing a lot of rapid fire trading every day. He had 3 screens in front of him and all of that. And he'd buy stuff at 10 o'clock and sell it at 2 o'clock, whatever else. I think that was just to keep his mind occupied. Okay, very smart guy. But these two stocks, with the guy who's doing this rapid fire trading and had a view on the market and view on every wiggle that the stocks market is doing and so on, he never touched these companies. And the reason these companies did well was that they were great businesses. And he never sold them even when they looked optically overpriced. So Titan became a market darling. Everyone loved Titan after 20 years. They understand the story really well. And it's like Costco. Everyone understands Costco. Everyone loves Costco or Walmart and so on. But so one of the important things in investing, which, is a departure from Ben Graham. While Ben Graham is regarded as the father of value investing, he also did, in my opinion, some disservice to us value investors. Because Ben Graham had an edict that was cast in stone. And the edict was that a stock should not be held above its intrinsic value. And actually, with due respect, and I hope you will pardon my blasphemy, the correct model, I believe, would be like the Buffett, Munger, or Chuck Akre model, which would be like Chuck Akre is a great example, and I think maybe you should see if you can get him to speak to you guys. Chuck Akre asked a question. He doesn't ask the question, is the stock above intrinsic value? He asked the question, is the business getting better? And if the business is getting better, then you need to give the lot of room. So let's say Titan is growing 15, 20% a year. And let's say the trailing multiple is a PE of 40, for example, or a PE of 50, very high, right? According to Rakesh, it is very clear the business keeps getting better. The more stores they open, the deeper the moat gets because they can amortize their designs over a larger pool, and the wider the distance grows between them and their competitors. And so while you would not buy Titan at 50 times trailing earnings or 40 times trailing earnings, maybe even 30 times trailing earnings, you should not sell it. So there is an asymmetry in investing, which Ben Graham didn't talk about or probably even didn't believe in, where at a certain price, I would not buy a stock, but I wouldn't be wanting to sell it. And so I think that when we make investments, so this asymmetry, between what price you would buy a stock at and what price you'd be willing to sell a stock at. So let me take a slight detour. The very nature of capitalism is that if someone has a great moat and is making supernormal profits, there are lots of incentives with lots of entrepreneurs and businesses to go into that business and wipe out those supernormal profits. That is the nature of capitalism, which means that something like Titan going for 30, 40 years, Costco going for 50 years, or Walmart or Southwest Airlines, these anomalies should not exist in capitalism. If you just took a theoretical point of view, these anomalies should not exist. But they do exist. And the reason they exist is that when an entrepreneur starts a business, the best that they can hope for in almost all cases is some what I would call arbitrage opportunity, which allows them to make some decent money for some finite period. So, for example, if in the Polanco district of Mexico City, there are no sushi restaurants or no great sushi restaurants, and someone opens a great sushi restaurant there, they will do really well for a while. But once other sushi chefs figure it out and they start opening sushi restaurants next to this guy, those profits will start eroding. Now, if this sushi chef has some secret sauce where nobody can match his quality of food or whatever else, it could become an enduring moat that could go on for a long time. So enduring moats are very hard to predict when you start. But what happens in capitalism sometimes is when you look back, you can identify enduring moats that somehow got built and even look like they might persist for some. And those are the ones to focus on. So one of the reasons the index is so hard to beat. So there are literally just about 4 or 5% of companies that generate almost all the returns that the index gives you. In the stock market, if you took out those 4 or 5% of companies, the market returns would be terrible. When we as individual investors are picking stocks, the odds are stacked against us because you have to pick 1 out of 20. And the odds of being wrong, and especially, you put on a cheapskate hat and you're trying to buy something cheap, and then you're trying to pick one of these 20 great businesses, cheap. Good luck with that. Very hard to pull off. And the index does so well because the index is too dumb to know that it owns Google, too dumb to know that it owns Microsoft, too dumb to know that it owns Costco, and too dumb to sell these things ever. And so it just rides these things. So just like we saw with Rakesh, 3% of his portfolio, which was a really small piece, which was probably at that time maybe worth less than $50 million or $25 million, becomes $2 billion. Okay. And what did he do? The biggest thing he had to do was do nothing. So the holy grail in investing is we will make a lot of mistakes. John Templeton said that the best investor will be wrong 2 out of 3 times, or 1 out of 3 times. Most of us will be wrong half the time. Even if you're wrong half the time, you can do really well. This is a very forgiving business. But the important thing is that when you find yourself in the happy position of ownership of a great business, you have to set aside Ben Graham. And if you can see the runway and you can see that it's a great business and it's going to keep growing, keep doing well, run by great managers, honest managers, then you just hang on to it for dear life. Now, if it gets egregious, so you can hold a business which is overvalued, but you should not hold it when it's egregiously overvalued. So we might consider Costco overvalued at 40 times earnings or 50 times earnings, but we should hold it. If Costco went to 200 times normalized earnings, it should have been sold a long time, because then now we've left the reservation. So sorry for the long answer. That's kind of how I think about it.